All right, let's get right into it. When it comes to picking stocks, the investment world is pretty much split down the middle. There are two major camps, two completely different philosophies on how to find a winner. Today, we're going to break down these two strategies, fundamental and technical analysis. I mean, this is the big question, isn't it? You've got some cash you want to invest, you see a company you've heard of, but is the stock a smart move or a total disaster waiting to happen? How do you even begin to figure that out? It can feel, well, pretty overwhelming. And this is where things get really interesting, because depending on who you ask, you are going to get one of two profoundly different answers. Seriously, it's a debate that's been raging on Wall Street for decades, and understanding it is absolutely key to finding your own way as an investor. So, first step, let's talk about the fundamental analysts. I like to think of them as the business detectives of the financial world. They're not interested in the daily market noise or the latest hot tip. Nope, they're trying to crack the case. What is this company really worth? The magic word here, the one you absolutely need to remember, is intrinsic value. That's the holy grail for a fundamental analyst. They believe every single company has a true underlying value, and their entire job is to figure out what that number is by digging through financial statements, looking at the management team, and analyzing the health of the entire economy. So here's the bottom line. Once our detective has done all that homework and calculated that intrinsic value, they compare it to the stock's actual price on the market. If the market price is lower, bingo! The stock is undervalued, a potential bargain. If it's higher, then it's overvalued, and they will stay far, far away. Pretty simple in theory, right? And their process is super methodical. It's a top-down approach. As you can see, they start big, looking at the entire economy. We're talking interest rates, GDP, inflation. Then they zoom in on the specific industry to see how competitive it is, and only then, after all that, do they finally put the company itself under the microscope. It's all about context. Okay, now let's completely switch gears and head over to the other side of the street. Meet the technical analysts, our market psychologists. For them, a company's earnings report or its debt, not that important. They believe everything you need to know is already reflected in one place, the stock's chart. This quote really gets to the heart of their whole worldview. They believe stock prices are driven by human emotions, good old-fashioned fear and greed. So by studying past price movements, they're really just studying human behavior, looking for patterns that tend to repeat themselves over and over again. And this right here is their primary tool. A stock chart isn't just data, it's the psychologist's patient. It tells a story of optimism, panic, and indecision. They believe all that fundamental information the detective works so hard to dig up is already baked into this single picture. One of the first things a technician is looking for are these levels of support and resistance. Just think of a support level as a price floor, a point where buyers tend to step in and say, nope, it's not going any lower. Resistance, on the other hand, is a price ceiling, where sellers tend to take control and push it back down. These are the battle lines. They also look for these very specific named patterns that have appeared time and time again throughout market history. This one you see here is a classic head and shoulders pattern. To a technician, seeing this shape form could be a major red flag that an upward trend is about to reverse. It is all about recognizing these shapes to guess what's coming next. Okay, so we've met our two investors, the detective and the psychologist. They both want to make money, but wow, they live in completely different worlds. Let's put them side by side and really see how they stack up. This slide really just nails the difference. The detective studies the cause of price movements, the company's financial health, to find long-term value. The psychologist studies the effect, the price chart itself, to ride short-term trends based on market mood. It's the difference between asking, is this a good business, versus what's the market's mood right now? Now, just when you think you might be picking a side, here comes a theory that basically throws a giant wrench into both of their plans. It's a really powerful idea that questions whether either of these approaches can consistently work at all. It's called the efficient market hypothesis. In a nutshell, it argues that the market is so fast, so smart, that by the time you get any information, whether it's from an earnings report or a chart pattern, it's already reflected in the stock's price. There are basically no bargains left to be found. And that's the bombshell, right? If the market is truly efficient, then the detective's hard work to find an undervalued stock is kind of pointless because there aren't any. And the psychologist's chart patterns, they're just random noise. No one has an advantage. So after all that, who wins the debate? The detective or the psychologist? Well, the reality for a lot of successful investors is
They don't pick a side at all. They combine the two. They might use fundamental analysis to decide what to buy, a good, solid company, and then use technical analysis to decide when to buy it, looking for the perfect entry point.
And that brings us to the final question, the one that really matters for you. Now that you've seen both philosophies in action, which one speaks to you more? Are you the detail-oriented detective digging for that hidden value? Or are you the intuitive psychologist reading the mood of the market? Or maybe you see the wisdom in using a little bit of both. The answer will really define your journey from here.